Welcome everyone to this Buyside Power Women fireside chat, where we will be discussing the way forwards for ESG investing and reporting. I'm Isabel Wong, Lynk's editorial lead and the host of this session. This Buyside Power Women fireside chat is brought to you by Lynk Global, a technology platform that powers the new knowledge economy. Lynk has been intelligently connecting decision makers and business leaders with over 840,000 experts across regions and industries. Lynk has also formed an official global alliance with UBS, powering the investment process of the wealth managers' institutional clients. Also, a little bit about Buyside Power Women. It is actually Lynk's flagship initiative that features conversations with female leaders and male allies in the investment management industry in order to increase visibility of women and their influence in investment decisions in the industry. The series actually covers the investment philosophies and approaches of these female leaders, and also how the advocacy for diversity could influence future capital allocation. If you would like to learn a little bit more about the initiative, you can also go to the link that's currently on display on the slide to check out some of our previous content and events. Now, going back to today's topic, which is ESG, basically 2020 was a year that was like no other. It was also a year that the environmental, social, and governance considerations in capital markets and financial services came of age. And the numbers actually speak for themselves. ESG funds are on track for a record year of inflows, attracting over $21 billion in the first quarter of 2021. And back in 2018, the whole year, the inflows were merely $5.4 billion. So we actually saw quite a bit of traction in this spectrum. And around this time last year, we hosted a conversation with another Buyside Power woman, Kimberly Stafford, who is PIMCO's head of Asia Pacific and managing director. And we were discussing the question about whether ESG was ready to take the center stage. But of course, this year, this is no longer the question. And the questions now actually focus on how the investment management industry will put purpose into practice and formalize their ESG commitments, and whether or not we can expect to see more clarity in this extremely ambiguous space. Now, joining us today is Dr. Ghadir Cooper, head of global equities of global investment management firm Barings. Ghadir currently leads a team of investors specializing in global, international, emerging, and small cap equities. She's a member of Barings' senior leadership team and also a member of the European management team. Previously, Ghadir was head of the EMEA and Global Frontiers team and lead manager on the Barings Eastern European Fund. And before joining Barings' emerging equities team, Ghadir worked at BZW Asset Management, where she was an investment analyst focusing on the Middle East, North Africa, and Latin America regions. Ghadir holds a BSc and PhD in theoretical physics from Durham University. Now, today's conversation will be split into two parts, where we aim to cover the current stage of play in ESG investing, as well as diversity and inclusion on the buy side. And later on in the session, we'll also open the floor to get questions from our audience members. So do stick around. And if you have any questions for Ghadir, please feel free to let us know as well. But before we bring in the speaker, now, here's a question for everyone. And we would like to run the live poll if we could. Bring up the poll now. If you could see the poll box and you'll be able to see the question, what will be your area of focus for your ESG investing in 2021? And you have got the options of A, climate change, B, human capital management, C, corporate purpose and culture, D, human rights and modern slavery, and E, supply chain management. Now, you could spend the next 5 to 10 seconds, vote in the poll and let us know what you think. And we'll later on, we'll check out the poll results to see where everyone is at with their ESG investment journeys as well. And a couple of housekeeping notes before we start the conversation. If you have any questions for our speakers today, you could feel free to use the Q&A function on Zoom, or if you're actually dialing in from your mobile devices, you could also send us your questions at insights@linkknowledge.com. We'll address some of your questions later in the live Q&A section. But now, Without further ado, let's bring in our speaker, Dr. Ghadir Cooper. Ghadir, thank you so much for joining us all the way from London for this session. A bit of question before we start the presentation is that in the past few years, there have been a lot of discussions around ESG as a concept, an idea. But after what we went through in 2020, the global investment management industry and corporations have basically come to a consensus that ESG is a business imperative and ESG risk is business risk. So now basically the billion or potentially $1 trillion question is how do we integrate ESG into investment process in a more sustainable and reasonable manner? And what's the current stage of play? And basically, what's your take on this?
Thanks, Isabel, for having me. It's a pleasure to be here. Let me just try and answer your question in a different way. Let me just explain what I think was the ESG journey and where we are in that journey right now. So I don't think ESG actually investing is a new term. I don't think it is something that we haven't been looking at least in the last 20 years as an investment managers. But I think it evolves from thinking about your return as an investor solely for the delivery of capital growth. So therefore, when I started my career, I was told always that the primary thing that you do is to give risk-adjusted returns which are good for your clients. And I think that actually evolved over the time of me investing, and we started thinking about, okay, there might be other things that you need to do in order to deliver your return. And that's when people started excluding sectors or excluding particular companies out of their investment universes. I think that was, again, something that is very much an outdated concept. I think at the moment, what investors think, what we definitely at Baring think, is that you need to combine looking at ESG or integrating ESG considerations into your investment process in order to improve the return that you deliver to your clients. So it became part of our fundamental analysis and fundamental decision making. And then that actually went further. If you really thought ESG integration is something that you want to do in order to improve or sharpen the capital return for your clients, surely actually unlocking ESG is something that you can do in order to improve that return. And this is when we started thinking actually not exclusion, but active engagement. And one further thing happened, and that's actually what you've been talking about in the last 2 to 4 years, is that this kind of idea of the fact that you can invest to deliver more than just return, and you can invest to deliver a social or an environmental objective apart, not just only the return, the capital return. And that's when you went into the realm of impact investing. Obviously, there's philanthropy as well. You invest in order to make everything better, but you don't really worry about capital. I think as an asset manager, we're really not here. We use our social impact fund to do philanthropy, but our concept is that active engagement, ESG integration helps you deliver the outcomes that are better for your clients and for the society. Do you want me to actually explain more exactly how we think about ESG as Barings? I think it's on the next slide. If you don't mind going to the next slide. So for us, there are 3 concepts that we thought were very important for us to in our journey, in our approach to ESG. The first one is that when we integrate ESG, we integrate it in every single asset we look at. So the idea here is that if you can understand the environmental, social, and governance characteristics of a company, you really understand it much better. You understand the risks associated with that investment, but also the opportunities that that investment has if you can identify those sustainable practices. It is less risky, it's better managed, it has sustainable practices, so therefore it is better to put those kind of companies that are either positive or improving ESG in your client portfolios. If that's what you think, then clearly your approach to ESG investing has to be dynamic. has to be forward-looking. You absolutely care about what the company was doing in the past, but it is not, sorry, do you mind going back to the previous slide? You don't mind what's happening in the past, but what you are actually trying to do is to understand where the company is going, and you want it to go and on that journey to better or improving ESG, because like financial returns are improving in the future, and we're long-term investors, we think companies that exhibit positive or improving ESG characteristics will be rewarded better by the market. And therefore, that's something that we look to identify and we look to cultivate. And that is our engagement approach. So we reward positive change, and we work towards it through engagement with the company to get those better outcomes. The next slide actually talks about it in a much more effective manner. Sorry, Isabel, you were going to say something? I interrupted.
Oh no,
them.
Actually you were about to answer my quick question, because initially I just wanted to ask, well, basically you did talk about the general approach to ESG integration, but it's just basically how can investors put these concepts into practice and have ESG considerations embedded in basically every stage of the investment process.
Sure, thank you for asking the question. So if you really truly believe that looking or considering ESG factors is really about controlling risks and adding to opportunity, I can put it in a different way. If you're investing in a company and you're an investor, you're investing in the future of that company, what the company earnings and cash flows would look like going forward. And therefore, any threat to those cash flows and any threat to those earnings clearly in the future would reduce or reduce your return, i.e. it becomes a risk to you as an investment. So for us, ESG was a way of understanding what the company's risks are not in fundamental analysis. But also, again, as I said, if you got a company that is less risky because of ESG considerations, that company becomes more attractive as an investment destination, i.e. it is less of a problem for you as an investor going forward to think about, okay, could that company's environmental management be so lax that you have to put a lot more capital expenditure, or you have environmental fines? So for us, that was the approach. We thought ESG adds value. And because our approach is dynamic, we thought, okay, how can we do that? And this is your question. So we had to go and take all of these ESG factors that we were actually looking at before this ESG term became popular and we're talking about it in the way that we're talking about it now. We had to put it in the framework of how we invest, i.e. our analysis of ESG had to change our thinking about the company or influence the quality of the company. And we came up with a proprietary ESG scorecard that has 9 factors, and I'll talk about them in a minute. But overall, the idea is that once you've assessed your company's ESG credential characteristics, forward-looking moves, you want that to affect your view of the company, but your value of the company. This is when we came up with the idea of a cost of equity. So when you want to invest in a security, you want to make sure that that security gives you adequate return for the risk that you're taking into it. And that return needs to hurdle all sorts of less risky assets, if you like, the bond in that country or the actual business model of that company, but also its ESG characteristics. So therefore, when we built our ESG scorecard, we built it so that those factors that we analyze affect that cost of equity. We reward good ESG behavior. That's why we take 100 basis points out of cost of equity, i.e. this company is less risky, deserves a premium in our view. Or we say, okay, this company is actually deteriorating, it's not improving its ESG practices, more risky, you need to hurdle a higher rate in order for you to be able to put it in your client portfolios, but also it's not enough. We need to also engage with those companies with deteriorating ESG characteristics, so we get the better outcome, not just for our clients, but for society. And actually the next page shows you what I'm talking about in practice. So when we analyze a company, our fundamental research, we're growth at a reasonable price investors. Our fundamental research is about our proprietary 5-year forecast for earnings or CapEx and everything else that you need in order to value the company. but we also look at the quality of a company. So we look at its franchise, its management, its balance sheet, because these are the characteristics that allow you to have confidence in your 5-year earnings, in your delivery of alpha. So when we looked at ESG, which is on the next page, we really focused on that quality side and how to integrate it in the valuation. So when we looked at the quality, we wanted to look at the franchise of the company. For us, a company is competitive and can deliver more and have more strength if it has a sustainable business practice. It can maintain its margins, it doesn't have blow-ups, it doesn't require me to worry too much about its supply chain if it is looking at these at the sustainability of its business model. So we reward better sustainable practices. We also look at management. Why? Because if you're protected as a minority shareholder, actually what you're saying is that the company is governed so well that it is governing also its strategy going forward, but also it looks after me as a minority shareholder, and therefore I can extract all of the return that I think the company will deliver for me. And also, we want to make sure that there isn't any problems on the balance sheet of the company that are going to make the company unable to deliver on its strategy, i.e. they might need to go do what I've just said a minute ago, environmental cleanup. That is money that goes out of the company, not to the shareholders. That's because it hasn't been managed well enough. So these are the risks that we need to manage. And within that context, we came out with our proprietary scorecard, because this is the qualitative assessment. So next page really talks about those factors that go into the quality of the franchise, into the corporate governance, and into the hidden risk on the balance sheet. So you can understand how at the start of doing this, we did this about 5 years ago, that there wasn't a lot of ESG data. It didn't have the focus that we have at the moment on ESG. It doesn't have the requirements from regulators to give me, for example, carbon analysis, net zero analysis, all of these things. So what we thought, actually, because our analysts know the companies intimately well, is to look at those ESG considerations that affect the quality of the company or the governance of the company or the balance sheet. We looked into SASB, we looked into GRI, we looked at the sort of issues that we were encountering, we were asking the companies about, and we put them into those 9 factors that allows us to really analyze the company well. I'll give you an example of a couple of those. So for example, we talked about the franchise and you asked about supply chain in the question at the start. If we can understand what the ESG supply chain of a company, so internet security, people supply chain in terms of actual geographies, if those companies are governed well, are improving their supply chain properly, all of their key inputs in ESG terms are looked after, those companies are likely to have sustainable business practices, are likely not to have headlines in the newspapers, and unlikely not to need to remedy all of those issues that come out of it. You also talked about D&I. So we use that, for example, we care about D&I because we think well-diverse companies, the ones that have better opportunities for gender diversity, for example, are better managed, have more ability to succeed because the opportunity set is wide. They cast the net wider, or their talent is working towards improving the governance. So we look at female participation in the executive as well as on the boards. This is one of the corporate governance issues that we look at. And if a minute ago I talked about a hidden risk on balance sheet, so environmental footprint is an easy one, but I'll give you another example. A company that has good business ethics, good whistleblowing policies, i.e. they are out, published, well-governed, no retaliation to them, are companies that allow the investors and society to sleep better, because those companies will have somebody inside the company who will blow the whistle, quite what whistleblowing means, on any practices that are not sustainable. Also, you ask for things like human capital or worst practices. That all goes into that. So what we do is our analysts, when they speak with the company, they analyze those factors in a dynamic way, from exemplary, which is best in class, or improving, not improving, to unfavorable. And this actually to us is a way of, if you like, quantifying the qualitative inputs that we see in the company in a way that allows you then to integrate that scorecard, integrate our view into the valuation of the company, which is, I think, is in the next page, talks about it a little bit more. Thank you. So you asked me at the start is how do you make it impact your decisions? We actually thought very clearly at the start of the journey, about 5 years ago when we did this, that it will be good to formalize the integration of ESG in the same way that formalizing systematic risk is there, for example. So I'll give you an example of this. If you want to compare a Korean car manufacturer and a Japanese car manufacturer and a German one, clearly the earnings would be in different currencies, and those earnings need to be taken to a currency that you can compare them with. So this is where we had the concept of macro risk being integrated into our hurdle rate of cost of equity that we talked about a minute ago. And that risk-free rate therefore equalizes those earnings to something that we can compare those similar companies in sectors and in different geographies. So we have to hurdle that systematic risk. We also add obviously an equity risk premium because equities are more volatile than, say, bonds. But in the same way that we think about it this way, we also need to differentiate between different business models that reflect sector risk, regulatory risk, balance sheet risk, management risk, and ESG credentials. And in fact, we're saying every company has to hurdle a systematic risk and give me a return that is higher than that cost of equity in order for me to achieve a proper risk-adjusted return for my clients. But also, we need to hurdle the differences in idiosyncratic risk. We add between 0 to 2% to that. And if the company is exemplary on ESG, we take away 100 basis points of cost of equity to reward that company. We're saying that company is less risky, and therefore that company deserves a premium. And the other way around, if we still think there are some ESG issues in the company, we add to our cost of equity to say, actually, we need to hurdle it more. I require a higher rate of return because of ESG risk than I would have otherwise. And that allowed us, sorry, Isabel.
No worries. Actually, an audience member actually sent a quick follow-up question about regarding your previous point. Before we would like to jump into the conversation about more about your active engagement approach. But this audience member is basically talking about the proprietary ESG score that you shared previously, and if you could also just quickly talk about whether you compile the data yourself or do you rely on any self-reported data to do that.
Actually, a very good question, I had to admit, because when we first started doing this, there was really not a lot of ESG data. So our reliance was on our view and us talking to the company. And actually, we conduct about 4,000 meetings a year for the issuers that we look at, for the companies that we look at, and we ask them those questions. Also, our analysts look after the companies for a long period of time. The average tenure of an analyst analyzing a company is a long time, so they know it intimately, so they know the history of the company, how does it look forward. We've been helped, though, by regulators, by all sorts of international agreements, whether it is the Kyoto Protocol, Paris Agreement, etc., where there now are targets and companies have to deliver data, if you like, in order for us to be able to rely on it as well. So we have external data providers that bring the data in. We've got the companies that come up with the data as well that we bring in from the companies directly, but it is the view of the analysts on the validity of that data. We use that as any input, earnings inputs, etc. We get also ESG data input. And for us, that is the important part, is that data is data, but is the view is what is important in making the decisions.
Right. And well, moving on with the conversation, you previously talked about the importance of course, active engagement in your approach. So could you please tell us a little bit more about how do you engage with companies to drive positive changes in their behavior?
So if you truly believe that that ESG is a factor, if you unlock, you add value to your investment, i.e. our whole idea of rewarding positive change and really not liking deteriorating ESG standards, then in that framework, it becomes like an improving return on capital employed. It gives you more reward for your investors. We thought in that case, as active managers, we also need to unlock that value. And we thought there's two things that we need to do. The first one is asking companies to disclose more. So this improved disclosure, like what I've explained to you a minute ago about whistleblowing, something that you have to go and talk to emerging market companies about because you want them to understand the value of whistleblowing. We engage with companies to actually come out with much more disclosure. But we also identify issues, ESG considerations that are not as good as we'd like them to be, or as can be for a particular issuer. And these, using our proprietary scorecard, we identify those issues, we design an engagement plan that, for example, we would like to go and engage the company on the fact that female participation in the workforce isn't as high as we'd like it to be, that you don't have too many independent directors on the boards, for example, in the case of some Japanese companies, or you engage with them in order to understand what their environmental behaviors are and what are the likely safeguards that they're taking to do no harm while they're extracting minerals out of the ground. And for us, therefore, we design an engagement plan based on the materiality of the issues that we believe the company faces, but also because we care about human rights, environmental factors. We're signatories of UNGC, we're signatories of PRI, so these are all factors that we care about when we engage with the companies. We speak with C-suite usually, or somebody who is specifically tasked to improve the ESG standards of a particular company, and we iteratively talk to them. So we continue to add our voice to, I'm hoping, more voices from the industry in order to unlock those practices and therefore change those cultures and behaviors.
Right. And a quick follow-up question here is that, of course, you talked about this active engagement, but you can't be engaging every single company. There's got to be an initial assessment around it, right? But let's say if there's a company that's doing poorly in ESG right now, does it mean, in your view, it will still do poorly in the near future? And is there a way for you to assess whether or not there's potential for a company that's currently doing a lackluster job in ESG? There's a potential for that company to perform better in the near future. How would you decide whether or not you will engage?
So if you remember what we talked about assessing the quality of a company, we think the quality of the company is good enough and it is growing going forward. But we think there are ESG issues with the company that we have at the moment. If we decide to invest in that company for our client portfolios, we also make a commitment to engage with those companies going forward on those ESG issues. So last year, for example, we cover between our analysts about 1,500 securities. We engaged with 250 companies on different issues. We continue that engagement this year and we'll carry on engaging with those companies. Remember, our companies are usually better quality companies and they are behaving in a good way, but we don't believe in exclusion, because what happens is that those companies could be systematically important for us as a society in order to deliver clean energy, or to deliver on EV vehicles, or deliver on all of the pledges and commitments that we have for the environment. So therefore, engaging with those companies is much more important than excluding them. Excluding them, they will still sell the the minerals that are needed for the metals that are needed for the future of a clean energy, but we wouldn't be able to exhibit influence to make them change their behaviors. In fact, this slide, thank you for moving the slide, just talks about the fact that we are committed to doing so. We've pledged to do so. We've signed PRI in 2014. We are members of UNGC. These are part of what we said as an institution that we care about and we engage with the companies. But it's not just the equity department, by the way. Engagements also happens in our fixed income department. So everybody is working towards better outcomes for our clients, for the companies, and therefore for the society. So you don't mind going to the next slide? So basically, just wanted to make sure that you that what I'm saying kind of makes sense. If you want to read more about it, you can go onto our website, and there are some written pieces on ESG to talk about why we think engagement is actually a better way of getting the societal outcomes, but also better outcomes for our clients, because we believe that better outcomes actually require better practices by the companies themselves. And in there, we talk about, for example, sustainable agriculture. We need to feed the world. We need, therefore, to farm it. So what does that really mean in terms of ensuring that the impact is on the planet is minimized? Or what is happening in the mining sector? We still need copper, nickel, aluminium, all of those, lithium, all of these minerals in order to get your mobile phone to work, your washing machine to work, but also your electric car to go. So for us, engagement really is at the core of what we'd like to do relative to exclusion. And those are all on our website if anybody would like to read them.
Thank you for sharing your insights on the approach on how to execute ESG integration effectively, Ghadir. Before we continue with the conversation, I do see, a couple of questions coming in. We will address those in the Q&A section later. But now let's check out the results of the poll we did earlier in the session. If you could bring up the results, please. Now, let's look at everyone's area of focus this year, and 47% of the audience member is focusing on climate change, and then 20% on human rights and modern slavery, 17% on corporate purpose and culture. While it basically aligns with the current sentiment about the high level focus on the E element, but it's also encouraging to see maybe some of the S related elements are also slowly catching up, which we will talk a little bit about in the conversation later. But before we move on with the conversation, we have one more question for our audience members. And in this upcoming poll, you will see the question, which of the following sources of information do you think will be the most effective for you to evaluate corporate culture and ESG commitments? And you've got the options of A, regular engagement with management, B, regular engagement with the board, C, disclosure of quantitative human capital indicators, D, word of mouth, social media and news, and E, ethical policies. Of course, Ghadir can tell us what you think later on in a Q&A section, but please just go ahead and vote. Let us know what you think will be the most effective for you, and we could also look at the results and check out what everyone thinks later on when we wrap up the session. But now, I would like to come back to the conversation with Ghadir on a slightly different topic, because at the core of the Buyside Power Women initiative, we would also like to amplify the achievements and voices of female leaders in the investment management industry. So there's definitely no better time for us to leverage this session to have that conversation around female talent development on the buy side. But first of all, we would like to get to know a little bit more about you, Ghadir. Could you tell us a little bit about your career journey, and at what point did you decide a career on the buy side would be for you?
Mine is probably typical of a lot of females of my generation. It was quite a lot of it was random walk. So when I came to the UK to study, I did a PhD in particle physics. My aim was to finish that PhD and go back to the Middle East, where I'm from, and teach at a university, because I thought that career will give me independence. However, as life always interferes with your best paid plans, and actually came out with even better plans, I met my husband, so therefore I stayed in the UK and decided that the best thing to do is to figure out what I want to do with my life. And at that time, I am now 53. At that time, we were all encouraged to either be lawyers, accountants, or go into the city. So I went into the city. And I absolutely loved it. I took to it like duck to water. I started by being an analyst because I spoke Arabic in the Middle East. So I was an emerging market analyst and then fund manager for a big part of my career. And it just went from there. That's how I started my journey on the buy side, and that's how I stayed on the buy side. So moral of the story, always turn up to the opportunities that you have, and don't be fixed about where do you want to go from A to Z. Actually, what you want to do is to respond to the opportunities that you're given and enjoy what you are passionate, do what you're passionate at.
That's a great advice. Yeah. So, but Ghadir, in your view, do you actually see women could actually make better investors after having spent so many years in the industry? And what exactly are the strengths of female investors and capital allocators?
Yeah, it's a very loaded question. Do I think women or gender in particular make better or worse investors? No. I don't think gender is a determinant. I think women and men bring different genders bring different diverse ways of thinking about problems and also a different way of solving that problem. So therefore, having different diverse fund management talent within your organization allows you to achieve a better, if you like, risk adjusted return, because diversity and bring your authentic self to work allows you to get the better outcome. Another way of saying it, what you don't want to do is block talent that is female or that is going to stop you from being able to achieve the best achievement you have. The culture changes, the way you get to the answer changes, the returns to your investors potentially can change. And for me, what is important, therefore, is to open the opportunity set for everybody, including female talent.
Mm-hmm. So, following up on that, another how question. Basically, how could buy-side leaders like yourself do to make a difference and create a gender-neutral culture in the investment management industry that is notoriously not a very friendly industry for women? That's the general sentiment. Basically, how can we on the buy side, what can we do to attract and retain and develop female talent?
We've actually said it. What can we do to attract? That's the first thing that we need to work on. What do we need to do in order to allow the working environment to be so good that your female talent is not leaving it? Retain. And how do you empower them in order for them to succeed and be able to be really an addition to your firm? Attraction is a big piece, because there you need to work all the way from the school side, because actually there's a lot of biases in different systems. We need a lot more, so for example, talent that can do science going forward. So therefore we need to go into the schools and tell clever female children that they can do maths and do physics as well as anybody else, and they shouldn't be taken away from it shouldn't be that their norms are the norms that they see in society, like you've just said about the fund management industry, is really how it should be forever in the future. So that's the first one. Then you go at the time they're about to leave university and attract them into your workforce by making sure that your organization embodies that. You have female leaders in your executive. You have policies that allow your the attracted female talent to come in and thrive within your organization. What does that mean? That means when they join the ranks of your organization, you need to enable them to succeed in their chosen career. And that is equally right for men, but women sometimes take time off to have children or look after elderly relatives. You need to make it so that that doesn't hamper your career and you are able to still work with the right balance of being able to come to the office, do your job, but also if you have other commitments to be able to deal with that. And that requires two things. That requires that culture to be embedded within the organization, allowing for it. And that's easier done for companies of our size than for smaller companies. But also we need to work so that legislation changes, so that the legislation allows for equal opportunity. You can take equally maternity leave and paternity leave, so that the employer is really blind. They don't really know if when females come to an organization, whether it is them or their partners or somebody within their relationship is the person who is going to be taking the maternity and paternity leave, because then you stop biasing advancement, unconsciously biasing advancement opportunities. You also need to enable your female talent during the time where they might want to take time to look after their families, to be able to do so. I think at the time we were talking, Isabel, before I told you, if I have female talent, 3/4 of that female talent, or even 2/3 of that female talent a week is better than no female talent during that week. So that's another thing that we work towards. But also, the other side of it is ensuring that you are helping advance your talent, regardless of what it is. It's not just female. It is just creating that equal opportunity set that allows everybody to thrive. So I don't want it to sound like we're continually positively trying to positively change the outcome. What we want to do is positively influence the opportunity set, because then it is up to people, associates, how they go up in the organization. You need to kill the glass ceilings, and you need to give that opportunity set going forward. This is what we try to do.
That's definitely an encouraging note to have. And now we will be moving on with the conversation by addressing some of the questions from our audience members, because I do see quite a few coming through. But going back to the ESG topic, first of all, I would like to talk a little bit about the regulatory environment currently, because basically, it's a space that's full of ambiguity. And even in Denmark, which is the world's greenest countries, asset managers are still trying to figure out how to adapt to new and evolving requirements for climate-friendly portfolios. So while we don't expect like a solid answer, but in your view, how soon do you expect there being a little bit more clarity on the regulatory front in ESG? And if it's not going to be anytime soon, what's the current biggest hurdle?
Actually, that's another question where we spend a lot of time at work discussing, because there's two things that you want to achieve. You want to achieve the outcome, zero net carbon at some time in the future. In some pledges is 2030, in some pledges is 2050, with different countries. That's the pledge of the countries, that's some of the pledges of the companies. So therefore, actually, you are on the right track for the right journey to come up with the ESG outcomes. The other side of it is regulation and the change of regulation and how that impacts your journey, i.e. do you accelerate some CapEx, do you make changes earlier? But also for us as asset manager, what does a sustainable investment look like? What does a really positive ESG investment looks like? And because you don't have standards, you really can't peg a company to a certain level, right? So this is why we are always looking at the taxonomy. And I think the EU is one of the first regulatory regimes that's trying to come out with a taxonomy that actually tells you what, how you are aligned with a particular environmental concern or social concern. But that is also being delivered much later than they originally thought, because of what you said, Isabel. There aren't enough, if you like, data points, but there isn't enough ability to compare companies with each other, because you don't have that data sets, you don't have their impacts. They are not like measuring a volume of water, right? Some of it will be, but some of it won't be. And in that journey, we learn a lot, but in that journey, we thought that having a proprietary way of evaluating the companies at least will give you to the right answer on your journey to net zero, for example, or for a social outcome.
Mm-hmm. Yeah, as you just mentioned, there isn't like a standard, or basically there aren't many established data points for people to create a benchmark or gauge. So this brings me to ask the next question, which is what is your approach when it comes to ESG risk assessment with companies of different scales and backgrounds? Because one interesting example I would like to bring up is that a private equity firm in Finland recently said they have developed a strategy that targets only small and medium-sized companies that are between 2 to 10 years old, because new companies don't represent the same type of legacy risks when it comes to issues like carbon emissions or gender equality, because they were born in the so-called more enlightened age. Do you agree with this approach, or what's your take on this?
Right. So it will be nice if you can just wipe off all of history and start afresh with the new sets of materiality issues that are basically understood within the norms of what we are seeing right now. This is not how the world works. The world has established companies. The world has companies that are still systematically important for us to feed the world and to build those bridges for the new infrastructure and run those cars that are going to be EV cars. So even though that might be an approach that allows that particular private equity company, and I don't know which one it is, but to be able to demonstrate influence on ESG issues, I think actually for us, what we do is we influence all companies that go into our clients' portfolios, whether they're companies that have been established for a long period of time, sometimes over 100 years, or whether they're companies that are newly established e-commerce companies that can talk about diversity and inclusion in a much better way than those old companies which are minors can. We also invest in small cap companies. Actually, one of our biggest franchises as Barings is smaller capitalization companies and emerging markets. And there we have also very, very different approaches, and we are on the ESG journey in a very different way. So for us, actually, we think it's much more important to influence everyone's journey, because that leads to better society and better outcomes for our clients, than just concentrate on the ones that don't have as much unlocking that, of that ESG value to go forward. And for smaller companies, they don't have reams of responsible ESG specialists. You know, they usually have fewer people on the boards. That doesn't mean that their ESG practices are worse. It just means that their ESG practices are not as well publicized as fully funded larger companies. And that's when our analysts, knowing the company intimately, because they are the ESG as well as the fundamental analysts, comes to play. So that approach is fine, but for us, we engage with all of the companies that are into our clients' portfolios to unlock ESG value if we needed to.
Mm-hmm. Okay, so another question that came through is basically about if you could address impacts, value creation strategies in public and private companies. Is there a difference between the two different types of companies?
Okay. So you are asking, I think the question is, if you are an asset owner as opposed to an asset manager, i.e. if you are owning this private company, would your addressing of the ESG factors be different than if you are a minority shareholder in a public company? I think this is the question, but I might be mistaken. I'll answer that question, and whoever please ask the question, please type again if I've misinterpreted it. If you're a private equity owner, so you own a slug of the company, you can influence the practices of that company by virtue of the fact that you are on the boards or part of the management teams. Therefore, you can create the policies and the culture that is needed for better ESG practices. You have influence by virtually being the manager or the asset owner. And you have seen a lot of work, a lot of pledges from asset owner alliances about carbon or about diversity and inclusion. That's one side. If you are like us, who is in our equity department, who are investing in public equity as a minority shareholders, we can do two things. We can use our votes to influence ESG outcome, which we do, or you can engage with the companies in order to change those practices. We engage in two ways. We engage directly with the companies on ESG issues that we have identified by virtue of the fact that we talk to them all the time and they know us. And also that means adding our voice to others who hopefully are engaging with the company for the same reason. Or we do what is called collective engagement, and that is engaging with other asset managers on issues that we believe are very important to us. So for example, we're part of Climate 100 Plus, which engages with the top 100 companies that are systematically important for the environment. We are a part of 4 engagements, and we co-lead on 2. That already tells you how we think about engagement and how we think actually, even if you're a minority shareholder, you should aim to influence behavior. If you're a private equity owner, you can influence it by virtue of managing it. For us, it's using all of the tools that we have in order to change that behavior and improve outcomes.
Right. And a quick follow-up question about your approach to engagement at Barings is that this audience member is basically asking, in terms of your engagement to drive robust ESG understanding, what is new in terms of who you engage with and how you engage?
It's that's also a very pertinent question. You want to engage with decision makers in the company. So therefore, your engagement needs to be aimed at either C-suite or a director of ESG that is sitting in that company that starts to improve the ESG practices. That's who we aim to engage with. So we engage with those, with the companies at the C-suite level. We also, as much as we can, we also, as I said, use our influence in terms of voting. So we can vote against management on ESG issues if we believe that they need to be improved, for example. I'll give you an example where that is important. Let's take our whistleblower policy example. Say you are engaging on human rights, okay? You want to engage with the decision makers in the company on human rights. You want to ask them if they have a policy. You want to ask them if that policy is published. You want to ask them how it is governed. Are we going to be able to see violations? You need to ask them who in the C-suite is responsible for that particular policy. And you also need to ask them if they have a fully working whistleblower policy, because all of the above can be blown out of the water by somebody who's whistleblowing on the company if they don't have all of these things sorted. So for us, you can see the approach, right? The approach is C-suite, who's responsible? Do you have a whistleblower policy? And that's for us, and whether it is governed well as well. So Isabel, I hope that answers the question. Go to the top.
Definitely. But and another question that might be slightly relevant to who you engage is basically we have another question from the audience that basically he's curious to know if Barings has any plans to dive deeper into the investment of supply chains beyond cybersecurity and key points protection. That is there an intention to hold investments accountable for supply vendor decisions based on ESG?
That's a good question. And I think because of ESG evolving all the time, you actually need to add more and more depth into the way that you talk to companies about issues, but also require them to exhibit or to show us how they control their own suppliers in supply chain management. For example, as Barings, we govern our suppliers. We're responsible for our suppliers give us. So therefore, their policies is our policy. We need to start thinking about the same thing in terms of companies and ask them what their supply chain management on human rights, for example, etc. as well. We know it is not perfect anywhere in the world. We've seen scandals recently everywhere. What we want to tell companies is that we want them to engage with their suppliers to improve standards. We want them to ensure that there isn't modern slavery inside the system. We want the auditors of the companies to audit that in a way that allows us to think that that is already being looked after. So it's not just an audit of the numbers, is an audit of the practices as well. So this is something that we think is going to continue to be evolved, and it's going to be important. Supply chain management, that's why we put it as part of our franchise, is an important part of the ESG credentials of a company.
Right. And the next question is about how soon do you expect ESG accountability flowing through to SMEs at scale? Are there any markets basically achieving this currently?
Um, Again, it's one of those questions. You're asking how could ESG and non-financial disclosures become the norm, i.e., at what level of, in which year time horizon do you think we will start talking about ESG in the same way that we talk about financial metrics? I think we're a long way off from that. I think we're going to be working towards that. If we don't have standards, we can't hold people to standards. If we don't understand what we are asking for, we can't measure what we're asking for. We can't quantify the impact of what we're asking for. We can't really see that. I think there's a lot of alliances that are working towards coming out with those international standards. It started with GRI and SASB, but I think that will continue. SFDR will help in that. But I think this is a journey, and we're still at the start of that journey, Isabel.
Right. And yeah, so the next question is a little bit about like clients for the investment management industry, because it's an interesting question. Basically, it's saying that female clients are more likely to prioritize ESG impact when considering what companies or funds to invest in, while male clients are much more likely to prioritize financial performance. Do you agree with this statement? What are your thoughts?
It's a misconception, I think, because if you look at the list of signatories for PRI, it's only going in one direction and it's going upwards. So it's actually increasing really, really quickly. And therefore, you can't say that there is a gender bias in that United Nations Principles of Responsible Investing, right, which is the ESG part that we're talking about. I actually think it is dependent on the geography you're in. So Europe is ahead of a lot of other jurisdictions. I think Asia and the US are following suit very quickly. And I think actually it's about what your pension fund outcomes are, requirements for outcomes. Does your pension fund, for example, ask you to give just financial return, or does it actually might sacrifice some of that financial return for societal impact or for achieving something different to just financial return? If your pensioners enable you to do both, then you can go to your investment managers, such as me, and just say, I want you to achieve a financial return, and at the same time, I want you to engage with companies on social issues, or I want you to achieve financial returns, and I want you to run it to a certain carbon footprint in your portfolio, so that you are actually continuously reducing the footprint of my portfolio, even if that sacrifices return. And I think this is where the industry is going. And it's not female, male, it's understanding the outcomes that you need. Going back to my first slide, what is the outcome that you need as an investment for your investments? We're finding actually a lot of the younger generation, for example, are requiring outcomes, which is different to the retirees who are about to go into pension and retirement, where actually they need that money to live. So we are seeing actually pressure from both sides, i.e. what we'd like to have is increased alpha, what we'd like to have is capital returns, and along the way, can we improve societal outcomes? And that, I think, is where we are at Barings. This is why we chose an engagement. But I don't think it's a male-female bias. I think it is just the world is moving more towards better ESG practices, regardless of where it is.
I see. Yeah, and the next question, very quickly, is that this audience says sustainability standards overlooked by IFRS are expected to be adopted by 2022. How will that change your approach and assessment of companies' ESG performance? Or I would like to add to that, is just like as we gain more clarity with ESG standards, how will that eventually impact your way to approach ESG investing? Will it evolve over time?
Our ESG investment is never static, will always evolve. The more data that you get, the more ability that you can compare that data to each other, the more likely that you would make better decisions. And we're trying to get that by requiring our companies to deliver that data more and more. Yes, there will be more SFDR, and all of those requirements on taxonomy are likely to imply that companies will report to those taxonomies, and therefore you'll be able to compare them with each other, and therefore you're able to understand where the company that you are invested in is relative to that journey. And I think this is something that is going to happen globally. You know, when you define something, when you have a value for something going forward, that's when the returns to that value become important. At the moment, we don't have that. We have some taxonomy on environmental factors. We don't have a lot on societal factors, and the governance one has always been the most the easier one to track, because companies talked about their governance all the time. This is their sometimes raison d'etre, right? So therefore, for us, the more standards you get, and I think we're due to get the next update on in September for 2022, and we don't even know whether that will be 22 and we kick it back to the future in 2023. But that doesn't really matter, because the direction of travel is clearly for better disclosure and for us to be able to compare and contrast between companies. And that's how we would evolve with that.
Mm-hmm. That is indeed a very good takeaway, but I'm afraid we will have to leave it there. Thank you so much, Ghadir, for speaking with us. That was Dr. Ghadir Cooper, Global Head of Equities at Barings. But before we go, let's quickly check out the results of the second live poll we did earlier to see what you think would be the most effective source of information that will help you better evaluate ESG commitments and corporate culture. So while you are checking out the results, this is it for this edition of Buyside Power Women Fireside Chats. Lynk users will be able to catch up on all of our previous conversations on demand in the Lynk Answers platform. You just have to log into your Lynk Answers account and go to Lynk Insights section, and you'll be able to catch up on all of our previous conversations, including our regular Lynk speaker series. Now, please follow us on social media. We're on LinkedIn, Instagram, Facebook, Twitter, and WeChat. And thank you very much for tuning in, and we'll see you very soon.